Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just want to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all my own original work, and I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so for a full year now, had been, though it's once again being tested and breached, it is the dark blue September to December 2024 bear channel, currently 1229 to 1656, that developed into a descending expanding wedge pattern. We are today testing the upper bear channel, and I have pierced it after trying to do that most of last week. However, we have not stabilized over it as yet. The next immediate resistances above are the August and July highs. They're at 1705 and 1702 respectively, though I suspect these were there because of the slightly higher April 2017 high at 1716 as a resistance. Meanwhile, support below is from the declining mauve medium moving average, currently at 1633, and the green short medium moving average, currently at 1615. Though these are ably matched by the February 2020 high at 1591 and June low at 1619 and congestion around 1633 to 1634, and now also the May 2017 high at 1659. Previously, I'd spoken at length about another pattern. That's the late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew some 30 weeks ago. And it seems to be a better contender in showing the bearish angle of attack, but this is no longer true, and I'll retire the pattern after this commentary. There is another larger bearish pattern which I have also previously spoken about, and a good contender even now in showing the bearish angle of attack, is the longer term bright red November 23 to September 24 shallower bearish shift pitchfork. On this one, we are between the bright red middle time below, currently at 1527, and the bright red upper time above, currently at 1862. Overall, as I said 2 weeks ago, and I quote, I suspect something is going to give, and soon, and I am on the watch out for what it will be, end of quote. This move higher could be it, but please be aware that this might still be a false break. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three patterns is the obvious and broken, then repaired, and then broken again, purple late September 24 to mid-February 25 descending expanding wedge pattern. Currently 454.10 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary, made back in January this year, and had earlier been severely tested on the top side, especially between late February to mid-April, enough that I would not necessarily classify as a descending wedge pattern after February, though I'm still keeping an eye on the extension to the upper trend line and the recent seemingly failed break above it, as well as the changeover gap 3 weeks ago, as I believe it all to be significant. Next, I also asked you 23 weeks ago and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork. The more the market moves lower through it, the more I'm beginning to like it, end of quote. Well, since then, the market started utilizing the bright pink middle time of this bearish shift pitchfork, which is currently at 466.60, as an attractor, riding prices lower in a shallow glide. Even now, though about 19 weeks ago, the market seemed to become caught in the well-highlighted overhead congestion between 489 even to 490.10, and the bright green extension to the April to June 2021 Head and Shoulders neckline, which is currently at 494.40. Now, we had a single attempt over it back then that was tapped back down 5 weeks ago, and that was by the declining gold long moving average, pushing it lower, currently at 497.40. But then held up from below by the seeming support of the February 2020 high zone at 456.70, which is where we finished last week, having spent 2.5 weeks down there. Now, I asked the following question 11 weeks ago, and I quote, "What it seems to come down to is whether the market has the bullish incentive to push up over the pink middle tine, the purple upper trend line, and the bright green neckline extension right now." End of quote. 5 weeks ago, we tried higher, and it had enough of a bullish incentive at the time to do that at the start of that week, but not enough to sustain the move higher, only making just the one single close over all three resistances before falling away to make that week a weekly key reversal down. I also said 9 weeks ago, and I quote, "There also seems to be no immediate appetite to push too far lower right now." End of quote. And I actually continued, and I quote, "It all depends on what happens between where we are now and the February 2020 high at 456.60, because I imagine under that, we might well see some fresh sell-stop selling emerge." End of quote. Well, prices did push down below the 456.60 level, even closing below it twice consecutively. But they did not manage to find any stop selling, though we are not too far from it, where that level is at the moment right now. I also added the following 7 weeks ago, and I quote, "In that it all depends on what happens now down below the February 2020 high at 456.60 and over the green neckline extension, as I suspect that despite the overall bearish pressures, we may see a sideways rectangle pattern start to emerge between about the 456.60 level below and the 493 even level above." And that's the end of the quote. This rectangle pattern, originally with the breach higher 5 weeks ago and then more recently with attempts lower over the last 2.5 weeks, should be signaling that the rectangle pattern may be seeing an attempted breakout with all the potential that has. However, nothing has matured and stabilized enough to call it a breakout. The final feature is one that I'd preempted last time I spoke, is the second bow tie formation of the moving averages, made up from the short moving average, currently at 464.40, the green short medium moving average, currently 474.5, and the mauve medium moving average, currently at 475.60. It has a bearish tinge to it, and crossover happened on the 22nd of September. So what does it all mean? Well, it begins with the count. So between 20 to 25 trading days after the crossover, we may have one or more of the following: a change in trend, a reinforcement of a trend, volatility. Hence, watch carefully between the 13th to the 20th of October for one or more of these features. Sugar white premium spread. I said 3 weeks ago, and I quote, "Things seem to be trying to resolve themselves into a pattern," end of quote. And over the intervening weeks, they seem to be doing so, just not always the way I imagined they would. You see, we dispensed with an uptrend, as well as an associated mid-November 24 to early June 25 bullish shift pitchfork, and I thought we might be moving towards, as I cautioned for a number of weeks, and I quote, "I have a fear, and it is a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern," end of quote. And I continued, and I quote, "This would be a large pattern in time, probably from February through to November this year, and in height roughly between just under 100 up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility," end of quote. That possibility looked like being a real possibility until 3 weeks ago, when the market dropped down and below what I thought would be the lower bullish trend line, highlighted in dark blue, and that's currently at 116 even. 3 weeks ago, the market not only dropped below this, let's be honest, an unjustified trend line, but went on to drop and close below the gold long moving average, currently at 103 even, and to stabilize further down, dropping and closing below a new support line, the bright red neckline, which is currently at 97.50, of a new, simpler pattern. And that's the market opting to utilize, instead of a more complex diamond pattern, instead a February to early October head and shoulders top. Now, we are in the early stages of this pattern, but I think it's appropriate to lay out some potentials below for such a pattern, just in case. This is a primary target X in the 70 even zone, with a secondary harder to reach target X1 down at 43 3/4. You will easily note that the primary target X is at the lower end of the congestion seen between September 24 to January 25, between approximately 70 even to 85 even. Only concerted, consistent, and long-term moves over the new bright red neckline, now ideally over the slowly rising long moving average, could possibly assuage the bearish potential, at least as far down as the 70 to 85 even congestion.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.